Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. This learning module is understanding cash flow statements, so we're making our way down the list of financial statements now. This is the last module that focuses on one financial statement in particular. Then we'll get into, overall financial analysis from an accounting lens. But key two topics in this learning module, one, we're going to talk about different accounting standards. So how IFRS and GAAP treats or allows for the treatment of these different cash items. So interest received, interest paid, dividends received, and dividends paid. Pretty likely to be on the exam. Like there's not really a trick to it here. You just got to remember the different rules and options that you have under each accounting standard. And then from there, we're going to talk about cash from operations. So this section of the cash flow statement, and we're going to calculate cash from operations using some sample data, some sample balance sheets, some whatever data the questions give us. But put it really simply, cash from operations is going to be your net income plus any non-cash charges, so like depreciation or non-cash charges, and then either plus or minus some working capital items depending on whether an asset or a liability is a source or a use of cash. And we can look at that just by looking at the change in these items over a period. The vast majority of time in this learning module is spent on cash from ops. Kind of makes sense. Like there's a lot more going on in cash from ops as opposed to cash from financing and cash from investing activities. Like these are relatively straightforward. Like your financing activities are just going to be like any issuances of debt, for example, and then an outflow would be like a repayment of debt. Whereas cash from investing activities, the main thing that you're going to be concerned of here is CapEx, which would be an outflow in investing activities. And you could receive some inflows, like maybe dividends received from an investment or something like that. But the module doesn't spend too much time on these sections of the cash flow statement. The cash from ops has a lot more moving pieces and is more likely to be on the exam. So with that, we'll just jump right in. Here we're talking about some different classifications of interest and dividends in IFRS versus GAAP. So I have this table down here. I took it from my notes. Kind of just one of those things. Unfortunately, you just got to remember. There's really no trick to it. Under IFRS, like if we're talking interest received, interest paid, dividends received, and dividends paid, so the inflow and outflow of both interest and dividends. The way I like to think about it is that IFRS has a bit more flexibility. So in the case of IFRS, interest received can either be operating or investing. It's investing because you're receiving interest on an investment. Interest paid can either be operating or financing, so like interest paid on a bond or on a loan or something. Dividends received, same concept as interest received, either operating or investing. And dividends paid, same concept as interest paid, either operating or financing. So more flexibility for IFRS. For GAAP, everything is operating except your dividends paid. So like even your interest paid would be operating. It's just one of those questions. It's pretty common to be on the exam. So I would just remember this table, and it's easy grades if you can remember this. So if you look at the questions here, which of the following is an example of a financing activity on the cash flow statement under GAAP? Well, it's right here, right? It's going to be the dividends paid. So C. And then next, interest paid is classified as an operating cash flow under. So interest paid would be right here, this row right here. So it's an operating cash flow under GAAP for sure. So under GAAP, but may be classified as either an operating or investing cash flow under IFRS. Nope, it's financing under operating or financing under IFRS. B, it's operating under IFRS, but may be classified. Nope. IFRS has the flexibility, not GAAP, right? So it can't be operating or investing under GAAP. It must be operating. So our answer must be C, but we can read it anyway. So it's operating under GAAP, but may be classified as either operating or financing under IFRS, which is true. We can see that right here. Maybell Corporation reported accounts receivable of 66 mil at the end of Q2. So Q2, AR 66 mil. And then for Q3, they had revenues of 72 million and AR of 55 at the end of this quarter. Based on this information, the amount of cash the company collected from its customers during the third fiscal quarter is, well, first it's going to be the revenue. We collected 72 mil in revenue. I mean, we didn't necessarily collect the 72 million revenue. Some of it could be in accounts receivable, right? But we have 72 million revenue, and then the difference we collected 11 million from Q2 to Q3 in accounts receivable, right? We had 66 mil here, collected 11, now we're down to 55. So some of the 72 is going to be in this 55, but regardless, we collected 11 mil over the quarter because the decrease in the asset is an increase to cash, right? So if you decrease AR, you're increasing your cash because you collected the cash, and if you decrease your inventory, that's also a source of cash because you sold the inventory. So it's, kind of works the same way for all assets. So it's a 72 mil plus the 11, which is 83 million that we collected. In 2018, the company using GAAP made cash payments of 6 million for salaries, 2 million of interest expense, and 4 million for income taxes. Additional information for the company is provided in this table. So we have revenue, COGS, some balance sheet accounts, we have inventory, AR, and AP. And based on the information given, the company's operating cash flow for 2018 is closest to what? So the way I would do this is, kind of recreate the operating cash flow section on the cash flow statement, which would be net income. And then here you would add back depreciation, which we don't have in this question, so that's fine. And then you would, go plus minus any changes in balance sheet accounts that are related to operating activities. So first thing I'm going to do is calculate net income. Bring it down here. So net income is equal to, for 2018, revenue 37 minus COGS 16 minus 6 for salaries minus 2 for interest minus 4 for tax. So we get a net income of $9 million. And now we got to account for the changes in these balance sheet accounts. So we can start with the inventory. So from 2017 to 2018, we have more inventory on hand, which means we have to spend cash. It's a net cash outflow to increase this inventory. So it's going to be -4, a cash outflow. Then we have AR, where it decreased year over year. So it's a source of 3 million of cash, which is the difference. 3. And we can come over here to continue it. And then accounts payable, this is the opposite, right? So it's a liability. So we're decreasing our liability, which means that we paid more to suppliers. So we don't have that much outstanding for accounts payable anymore. So for AP, this is actually a cash outflow of 2 million. So if we sum all of this up, we get net income, which is 9, minus the change of inventory, which is 4, plus the increase in AR, which is 3, and then we subtract the decrease from accounts payable, which is 2, and we get 6 million. So our operating cash flow for 2018 is 6 million. We have a commodities trading company reporting an interest expense of 19 mil and taxes of 6 mil. So these are the reported expenses, right? Not necessarily cash paid. And then we have interest payable increasing by 3 mil and taxes payable decreasing by 4 mil over the period. How much cash did the company pay for interest and tax? So we can do interest first. So we have an expense of 19 mil. And we have a payable, so a liability, increasing 3 mil. So this is a source of cash, right? Because we're increasing the payable, we have more to pay in a future period. So this is actually a source of cash. So the amount we actually paid is going to be the expense minus the increase in the liability, minus the source of cash. So the difference between these two is 16 mil cash paid for interest. So looking at the answers, we can just cross out A. And then for taxes, going to be the same concept. We have an expense reported of 6 mil, and then we have a payable decreasing. So if we have a liability decreasing, it's actually a use of cash, right? Because we have to pay off the liability. So for paying off like a loan, we have to use cash, right? So we have so payable increasing, oh, my apologies, decreasing 4 mil, which we paid. We have to pay out. So the total cash outflow is going to be 6 plus the 4, which is 10. And our answer is C. Here we have a company that's reporting a loss on sale of equipment of 2 million in 2018. And we have depreciation expense of 8 million and a capex of 10 million for the purchase of new equipment. And then we have some balance sheet info here from 2 years. And we're asked how much cash the company received from the equipment sale. So we need to find the sale price. And in order to calculate the loss, or to calculate the cash that we received, the cash that we received is going to be the book value minus the loss, right? So we got to figure out the book value or isolate for the book value of the equipment that we sold and then figure out how much cash we received. So we can start here. We have a BOP balance of equipment. So we have the book value is 100 mil at the beginning of the year. And we have depreciation, accumulated depreciation of 40. And then we have 10 million. So this is the beginning of period. Now we're doing like in year. I'm gonna go EOP over here, end of period. So in year, we added 10 million in book value from the capex. And we also added 8 million in accumulated depreciation. This is both associated with the new equipment, right? And our end of period balance is 105 for the book value and 46 for the accumulated depreciation. So when we sell this asset, we actually completely wipe it off our books, right? So we write off the equipment value and the accumulated depreciation amount because we're selling it. So to get from here to the 105, 100 plus 10 to get to 105, we actually had a $5 million book value here. And accumulated depreciation 40 plus 8 is 48. So we had 2 million in accumulated depreciation that we wrote off to get to the 46 value. So the carrying value of the equipment was the 5 book value minus the accumulated depreciation, which is 2. So it's 3 mil. So it was worth $3 million and we lost 2 million on the sale, which means that we received 1 million for the sale of the assets. I guess right here, actually, this should have been carrying value. If you pick that up, that's great. But yeah, so basically 5 million book value minus 2 mil accumulated depreciation was worth 3 mil. We received 1 mil for it, which results in a 2 million loss. An analyst gathered the following information from a company's 2018 statements. So have some balance sheet accounts here, retained earnings, accounts receivable, inventory, accounts payable. In 2018, the company declared and paid cash dividends of 10 mil and recorded depreciation expense of 25. The company considers dividends paid a financing activity. Okay, so that's good because the question didn't mention if it was IFRS or GAAP. It must be IFRS in this case because dividends paid can either be operating or financing under IFRS. So it's good that they clarified it because they're asking what the 2018 cash from ops was closest to. So cash from ops is going to be, like I said, net income to start plus depreciation plus or minus the change in working capital or operating related balance sheet items. So first thing we can find is net income, which we can find from retained earnings, right? So the end of period retained earnings is equal to the beginning of period retained earnings plus net income minus dividends. So we have this, and this, and we can solve for net income. So 145 end of period is equal to the 120 beginning of period plus net income, which is what we're solving for, minus 10 million in dividends. So our net income, if we were to run this out, is 35 million. Great. So now we have the start of the operating section of our cash flow statement. And then for 2, we have depreciation, which was given, nice and easy, 25 mil. And then 3, we got to figure out the cash impact of these balance sheet items. So we can go one by one. Accounts receivable is an increase year over year. So it increased by 5 mil. So an increase in an asset is a use of cash. So -5. For inventory, it also increased year over year by 3 million. So one's going to get to pay cash for inventory. So it's a 3 mil outflow. And then accounts payable decreased year over year, which, because it's a liability, is a use of cash as well. So it decreased by 7 mil. So if we sum all of this up, we get net income first of 35, and then we add back depreciation of 25 because it's a non-cash expense. And then we subtract 5 mil for AR, 3 mil for inventory, and 7 mil for AP. And we get an answer of, this is what, 60 minus 10 minus 5, 45. The answer is B. Based on the information for Star Inc., what are the total net adjustments that the company would need to make to net income in order to derive operating cash flow? So, similar thing that we just did, but here we're just worried about the adjustments below net income. We're not worried about the net income itself. So we have some income statement items and some balance sheet items. Just cross out the net income because that's not what the question's asking. But we have depreciation 2 mil, which we're going to add back. So it's a source of cash. We have AR decreasing by 3 mil, so a decrease in an asset is an increase in cash. We have inventory increasing 4 mil, so we have to pay cash for the inventory, so we subtract that. And then we have accounts payable increasing, so an increase in a liability is a source of cash. So if we add all this up, what do we get? 5 minus 4 is 1, plus 5 is 6. So it's a 6 mil positive adjustment to net income to derive operating cash flows. Which of the following is an appropriate method of computing free cash flow to the firm? So free cash flow to the firm essentially measures, your free cash flow, the cash that you have left over after operations, to the entire firm. So this includes cash flow to debt holders as well as equity holders. Free cash flow to the firm is commonly used to measure a company's ability to service its debt, whereas free cash flow to equity is, only cash flow that's left over after paying debt holders. So it's only the free cash flow to equity holders. So that's more used for return calculations and, figuring out its ability to pay dividends, maybe stuff like that. But we have 2 different formulas for free cash flow to the firm. Definitely got to memorize these, very likely to be on the exam. The first one here is net income plus non-cash charges plus interest times 1 minus the tax rate, because, we get the tax benefit associated with interest expenses. And basically the tax that you actually pay is already reflected in net income. So you have to, take that out. You can't just add back interest itself, because what you get the interest back if you're looking at cash flow to debt holders, but you also have to pay the tax, right? So you only get 1 minus the tax rate back when you're thinking of free cash flow to debt. But anyway, net income plus non-cash charges plus interest times 1 minus tax minus investments minus working capital investments. So this is just like, the plus minus change in working capital accounts, which we've been doing over the last couple of questions. So if it's, an increase in working capital, net working capital, you're gonna subtract it because it's cash outflow. If it's net cash source, when you work through all the working capital items, you're actually going to add it back. But it's basically, just saying you subtract it if it's a use of cash. We actually also have another formula which kind of summarizes it. Both of these are useful because you can, depending on what information you get in the question, you'll have to use one of these. You can see this one here is cash from ops plus interest times 1 minus tax rate minus your investments or your capex. And this here, so cash from ops is, basically just a sum of net income, non-cash charges, and your working capital investments. So if you, sum all this, you get this exact formula, right? So cash from ops plus interest 1 minus T minus investments. So coming back to the question, basically they're literally just asking us to figure out the formula. So we can go one by one. Add operating cash flows to capex and deduct after tax interest payments. Nope. Add operating cash flows to after tax interest payments and deduct capex. Yep, this is it. An analyst has calculated a ratio using the numerator as the sum of operating cash flow. So operating cash flow plus interest and taxes. And the denominator is interest paid on its debt. And we're asked, what is this ratio? What does it measure? And what does it indicate? Well, this is actually, if you look at the numerator, cash from ops, which is, your net income. We've kind of went over this, plus depreciation, plus the change in working capital accounts, plus or minus. So this is, like I said, cash from ops plus interest plus taxes. This is actually EBITDA, which, of course, is a very popular metric that's looked at as a proxy of cash flow. And it's EBITDA over interest. So this is actually the interest coverage ratio. And the higher this ratio, so like let's say a company's EBITDA is 10 mil and they have 1 mil of interest, they can cover the interest payments on their debt 10 times over just using cash from operations, which is a really good sign. Very, very commonly looked at metric, especially from the lens of creditors when they're issuing debt. The credit worthiness and the capacity to repay of the company is very commonly evaluated using this metric. So come back to the answers. This ratio is an interest coverage ratio. Yep. Measuring a company's ability to meet its interest obligations and indicating a company's solvency. Yep, that's exactly it.